sense of the Fed's ability to manage this current inflation shock?
I think that it's really hard for them to manage this because one big reason is a lot of the inflation we're seeing at the moment are coming from the supply side. So whether it's just very high energy prices or supply chain issues or pandemic related issues around people not working and so on. So they can only do so much around that all. But given that, if you do have less supply than before, the only way you could really bring inflation down then is you really have to sort of really reduce demand dramatically. So supply has gone down, and so the same level of demand would lead to higher inflation. So you basically have to do a hard landing. You have to kind of really engineer a sharper landing if you really want to bring inflation down. You basically have to tell people, look, just don't drive so much. And the way you do that is you have to really, increase interest rates. And so the Fed has started to pivot in that direction. But they're still cautious because, as I said earlier, if you look at, they're basically saying they're going to raise policy rates to maybe 2 or 2.5%, at the sort of the terminal rate. But inflation currently is like 8%, and so in real terms, or let's say inflation in the next year is 4% or 3% even. At 2.5%, your policy rate is still negative in real terms. Like normally, when you go through a tightening cycle, your policy rate should end up being above inflation, and that means your policy is tight, and you're going to slow things down. So it seems like the Fed is saying that, given the current makeup of inflation, we just need to do kind of enough to do a soft landing, and that'll be enough to bring inflation down. But if you look at the supply issues in the world, you actually need a hard landing in order to bring inflation down.
Yeah, but Bilal, shouldn't we be thinking about the inflation issue through the lens of the most recent update to their framework, to the Fed's framework, which is to think about this in terms of rolling windows of inflation? And so there's an average inflation that they're looking at. And to add to that, there's an argument to be made that because this is a supply shock, and because there's now this idea in the zeitgeist, and there's probably some truth to that there's deglobalization happening, and that the U.S. has realized that they can't afford to have critical supplies be offshore, particularly in countries that might be less than friendly to them. So that in actual fact, you should be looking to keep liquidity around so that CapEx expenditure could be directed towards the creation of factories, to the building of factories, and to the creation of the framework to provide that supply. And the fact that with a oil shock, it's quite likely that we might have a slowdown in the economic activity in the West in general. So
just to inject here a little bit, because I think one of the wild cards in this cycle that I think is maybe underappreciated is the fact that household balance sheets in the US especially, but around the world really, are more flush with cash than at any time since, in the post-war period. And I mean, not just a little bit more, but like off the charts more flush with access to immediate liquidity, which means, to my mind, there's a reasonable chance that the typical models for supply-demand curves are going to be pushed substantially more to the right than maybe most economists are expecting. So, in other words, we may need much higher prices in terms of, supply shocks and prices of inputs in order to facilitate or catalyze a material slowdown in demand. Just because, households have a lot greater capacity at the moment to endure higher prices for longer. And so I wonder the degree to which that may provide an extra set of complications to central bank policymaking here.
Yeah, no, I mean, those are all really, really good points. And kind of at the heart of all of this is, how do you deal with supply, a supply shock, and in some ways the answer is it's hard for the central bank to be the only actor to deal with this all. in reality, what you need is a supply side response from the government in some ways. So, for example, you basically need a change in your trade policy to allow you to, make sure that you're only trading with countries who you have strong relationships with. That's not under the remit of the Fed. That's a trade policy dynamic. You need incentives to onshore manufacturing, to make sure that you have more manufacturing resilience. Again, that's to do with, issues around regulation, for example. So at the moment, one of the reasons companies offshore a lot is partly it's cost, but also it's regulatory arbitrage, because to open a factory, if you have huge amounts of regulation to do that, it's just too difficult to do that. So you basically do the regulatory arbitrage and have it in a country that doesn't have such high regulatory standards. And so there needs to be kind of a view on that as well. And then in terms of energy transition, for example, as a policy, again, it's hard for the private sector to do it itself. It has to be sort of government-led. So in reality, what you need a wholesale, governmental response to a supply chain issue. And then you need to have an accord with your allies. So like right now, Europe and the US, because of the Russia thing, they've got an agreement now that LNG from US will go to Europe. You kind of need an accord like that. So in reality, you need all of that to make all of this work. Just for the central bank to do this is the central bank's using a really crude, device to kind of deal with all of this. On some of the specific points that you mentioned, on the household savings, it is definitely true. There's the balance sheet is a lot healthier than before. The issue, though, from a growth perspective, is that if you think about savings rates in the US, they're now back to, if not below, pre-pandemic levels. Yep. And so that tells you that, people have, like they're not saving much. On top of that, their real earnings are falling as well. So they don't have as much purchasing power as before. And whether they can dip into their savings, their stock of cash to spend, it's really, really unusual for the savings rate to go negative. It just doesn't really kind of happen. So I think that there is an issue in the US and in other countries where the labor market at one level looks very strong, but when you scratch away at the surface, the labor market is much, much weaker than it looks. And I think that the pandemic has distorted the strength of the labor market, because there's a lot of people just who haven't been willing to work, or because of restrictions they haven't gone out, or because of schools they've been forced to stay at home. But when you remove all of that, which is happening now, you'll suddenly realize actually the labor market is a lot weaker than it first appears. And one way of measuring this all is that, number one, if you have a very strong labor market, real wages should be going up, not down. So basically workers should have more power than the companies. So they should say to the companies, your prices are going up, so my wages should go up even more, but that's not happening. Another measure is if you look at the employment ratio of working age population. Today, the overall number of working age men and women isn't back to where it was before the pandemic. So there's still this latent supply of people. And then if you look at hours worked, overall hours worked are still below trend. So people aren't getting the hours that they need to work. So one measure for strong overheating market is people can get the hours, so like if you're a worker, not everyone has a 9-to-5 full-time job. A lot of people have like hourly jobs where you basically desperately want to get to 40 hours, and instead you only get 30 hours. So you're not seeing that. So there is this kind of labor market weakness, I think, that's been underappreciated. So I do think that even though household balance sheets are relatively strong, there is some weakness there. Then also, if you look at the distribution of household savings, it is skewed to the richer end of the spectrum.
Yeah.